Mike, David.
It may have slipped out halfway. It may have slipped out halfway. I corrected myself.
Okay, Daniel.
Not enough.
David.
Yeah, I'll go with Daniel.
How are you, man?
I'm doing well. Thank you very much for having me back. How are you?
Good. Things are crazy in our world, but looking at what's happening in Japan, it's even crazier in your world because you've got the craziness in the Middle East. You just had the South Korean drama, and now you've got Japan. On the little cryptic note by Scott Bessent. Scott Bessent. But let me focus on first, and maybe we'll touch on Japan later if you think it's a good idea and it's important. But I want to focus on what's happening in the Gulf and what's happening in Iran. All indicators are pointing towards a massive attack by the US, potentially with Israel as well, that will also include the energy infrastructure. I'm just really surprised that we're here. But I think this is an important conversation. Like, how can the economy really take this? Can the global economy really take a full-blown war, which includes the energy infrastructure and the closure of the Strait of Hormuz again? Is there breathing room for Trump to do this? Does he even care?
Well, short answer is no. How much can the economy absorb higher oil prices? Most economists I've talked to agree that it's $120 to $150. Beyond that, we're getting a definite recession. Currently at 83. I'm still on the WTI 86 now. I said on your show prior, a couple months ago when I was first on, I maintain a $100 target by September if this war isn't resolved. I'm sticking to that. We got up to as high as 93 last week. Look, does Trump care? I can't answer that. I think you would know that better than I do. The second part of the question, can the economy sustain higher oil prices up to 120 to 150, I think, is the short answer.
For how long?
For as long as it takes for consumer goods to catch up to the price of oil. Let me explain what that means. So the oil price moves based on whatever reason that moves the oil price. Could be Iran, could be SPR being depleted, it could be aggregate demand changing. It doesn't matter. It's a very volatile commodity, and it takes some time for trucks to increase their prices, for grocery stores to raise their prices, for restaurants to increase costs because their fixed costs have gone up. It takes some time for the rest of the economy to adjust. There's no definite timeline that's agreed upon by consensus as to how long that may be. But if we have a sustained oil price above, let's say, $90 a barrel, I would assume that prices could start adjusting pretty soon after 1 to 2 months. Now, the key here is that business owners and restaurants and grocery stores, they have to believe that a sustained upward in the oil price is just that, sustained. If you believe that as a business that the price of oil is volatile, one day it's 90, the next day it's 60, and we're going to go back towards 60 to 50, it's probably not a good business decision to start raising prices because you're going to put yourself out of the you're going to make yourself uncompetitive if nobody else is doing the same thing. So if we have a sustained move above $90 a barrel, and if everybody believes that the Strait of Hormuz won't be resolved anytime soon, then eventually inflation expectations will become even higher, and the Federal Reserve will be forced to eventually raise the Fed funds rate, which we can talk about in just a minute. In short, I don't believe that the economy is on the brink of destruction right now. I think we'll need to see oil move above $90 towards 100, 110 and sustain above $90 for at least 1 to 2 months before the rest of the economy starts to adjust and the Federal Reserve will be forced to raise interest rates.
Have you spoken to anyone about what would happen to oil prices and obviously refining capacity and derivatives, refined oil as well, if this escalates into not just the closure of the Strait of Hormuz, but attacks like we saw the Houthi attack on the Saudi refinery, but we see that at scale in the UAE, in Qatar, at the gas field. in Kuwait and Bahrain and in Saudi, and obviously in Iran, along with the closure of the Strait of Hormuz, along with the Bab el-Mandeb Strait. And I know that sounds like a kind of worst case scenario, but we're getting closer and closer to that reality. Have you spoken to anyone on what that would lead to in terms of oil prices?
If we have all of that, the answer is no. I haven't asked that exact question. I can maybe offer a few of my insights. The Bab el-Mandeb Strait is significant only for the Suez Canal. I believe it is. So the Strait of Hormuz at full capacity, full throughput, before the war was 20% of the global oil shipping volume. Today it's much less, obviously. Now the Bab el-Mandeb Strait is significantly smaller, but it's significant for Europe. The closest route to Europe from the GCC is up the Bab el-Mandeb Strait into the Suez Canal and into Europe. If that closes, then ships will have to take a massive detour down through the South African Cape and go up. That's roughly 10 to 14 business days extra. So it's not like existential. The oil will eventually still reach Europe. It'll just be delayed, which is going to reflect into higher prices for things and costs for shipping. Less so for the Strait of Hormuz because there's no alternative route to take. If that's closed, it's just closed. In terms of your other scenarios where missiles are flying and you're shutting down oil pipelines and refineries throughout the region, we're looking at, we're looking at, I don't know. I haven't asked people exactly how high oil prices will go, but let's just think about this since you brought it up. What would need to happen? Well, the world will have to depend on the rest of its strategic petroleum reserves. In the U.S., it's already being depleted to near the minimum threshold. I'm looking into data from China because it's disputed, but China has been it's agreed upon by the economic community that the Chinese have been pretty much the saviors of the global economy so far because they've basically stopped importing oil and they've drawn down their own reserves. This obviously has a limited window. This can't be sustainable forever. And so the question is how long that can go on. I don't know. I really don't know. Most people believe that the Chinese as well as the Americans are reaching the end of the rope here.
Why do you think?
Yeah, go on.
Why do you think the Chinese are doing this? Why not let Trump sink the global economy and alienate himself further?
It's not altruistic.
Because China will go down with it.
It's not like, they're not doing this out of altruism, and they're not. Possibly they made a deal, right? Possibly Trump and Xi Jinping made a deal. I haven't read anything official, but that's one prevalent theory. But the Chinese they have their own interests at heart. The Chinese, even though they've become more reliant on EV over the years as opposed to the West, nobody still wants oil prices to skyrocket. That impacts everybody evenly. Grain prices, rice prices have moved up as a result of the GCC being blocked. That's not a result of the oil price going up. That's just separately, right? Other commodities have been impacted as well because of that choke point being blocked. Rice is the number one grain a food product consumed in China. So the Chinese do not want the Strait of Hormuz to be continuously blocked. Nobody wants the oil price to go up except oil companies and oil investors. And possibly Xi Jinping and Trump made a deal, but time will tell if the Chinese will abandon this and start really putting the pressure on to end this. Yeah.
A more cynical way of looking at it would be the Chinese intentionally saved the global economy to give Trump more breathing room. And this is just me speculating off the cuff, give Trump more breathing room on the financial side. So he keeps dragging himself further and deeper into this war, further depleting America's military, further depleting America's resources, further increasing America's debt. That's a very sinister way of looking at it. I think this is a possibility. I hope it's not the case. China just letting Trump dig his own grave. But that if Trump delivers on the reports that we saw yesterday, and a lot of indications that these reports are accurate in terms of movements on the ground in Iran and the Gulf today, that's exactly what Trump would be doing. He would be digging, bulldozing his own grave.
I don't think Trump wants the war to continue. I mean, even if that's true, we're assuming here Trump really wants this to. His own constituents are pressing. I mean, even Republicans are abandoning support. The midterms are in 2.5 months, and I haven't read a single report where the overwhelming public and that shows an overwhelming support of the Iran war from the American people. Nobody wants a repeat of Iraq, where we have boots on the ground and a prolonged invasion. And I don't think that Trump's interests lie in prolonging this war. Whether or not the Chinese are supporting, the economy is irrelevant to the fact that Trump wants things to end ASAP.
Yeah, the question though is based on what terms? Does he want the war to end with Iran fully controlling the Strait of Hormuz, and the cost that is incurred if that's the case to the American hegemony, the perception of American security, the petrodollar. So I think Trump would love to walk away, but he'd love to walk away with the Strait of Hormuz either partially or completely returning to the way it was. But the question is, how far will he go to ensure Iran does not control the Strait of Hormuz? Because according to the latest report, or Iranians themselves said, they want to control all traffic that goes into the Strait of Hormuz and 50% of the traffic that goes out. That's a pretty significant demand from the Iranians. So the big worry here, and I'm usually the optimistic one. The reason I'm more worried is that I just don't think the U.S. Would accept that. It's just too damaging to U.S. hegemony. And I've had some guests on my show tell me about the importance of the U.S. ensuring freedom of navigation in the seas as a foundation to the petrodollar and the U.S. dollar being that's kind of the grand bargain after World War II. The U.S. offers security. Everyone uses the U.S. dollar. And in the long run, this is why. Go ahead.
Okay, there's a lot of things brought up here. Let me just establish the fact that the U.S. as a whole is relatively insulated from this. The U.S., I think we discussed this last time, gets most of its oil imported from Canada and Venezuela, Albertan oil sands in particular, and it exports light sweet crude that's refined elsewhere, and it imports heavy crude that the U.S. refineries can refine and then consume. That situation in Iran that we're discussing right now obviously has a global impact because it impacts the price, and Americans feel that, and ultimately it impacts monetary policy as well. But it doesn't directly cause an oil shortage for the reasons I've just stated. With that said, Trump's pressures are twofold. One, it's not in his interest for an elevated oil price. And two, he's getting pressure from his international allies and perhaps even competitors like China. And so he wants the war to end because A, he may lose support for the midterms if the oil price stays high, and B, he's going to lose support internationally if the Strait of Hormuz doesn't open, which impacts oil imports into Asia and Europe more than America. And I believe you're making the point that the international community. Sorry, what was your question again, Mario?
Wasn't less of a question. It's because you made a point that I agree with, that Trump doesn't want this war, and I agreed with you. But it's he wants to walk away, but how much is he willing to accept in terms of concessions for Iran? And I think the big sticking point right now is Iran wanting to control the Strait of Hormuz, which will be a big slap in the face for U.S. hegemony. And that is a concern that I have. That is why I'm more worried than ever this week that we may be dragged into a war that makes no sense for people that look at this logically, like me and you. Because you're looking at this very logically. Politically, it's damaging for Trump. Economically, it makes zero freaking sense. Just walk away. Let us recover from the damage already caused. But I just think he cannot walk away with what Iran is trying to get out of this.
Iran made a few demands earlier, a couple months ago, that the U.S. just outright rejected, right? War reparations. I believe they didn't come to terms on that. Okay, just on the issue of control of the Strait of Hormuz, let's just look at this objectively here. Suppose the U.S. and the rest of the world were to accept an armistice whereby the Iranian regime were to control the Strait of Hormuz. That's part of the deal. Who would oppose that? Saudi Arabia and Oman, which is to say the Americans may lose an ally in Saudi Arabia, or at least weaken the alliance, and in Oman as well. Do the Americans care I would say the Americans care a lot about their alliance with Saudi Arabia. Not only do they have a military alliance, they have a very strong economic partnership as well. Having been trading partners for years, they've recently just concluded a nuclear deal, as you may recall. It's not in the Americans' interest to just give up that strait because they have a vested interest in the allies directly occupying that strait. Now, what can the Americans do to stop the Iranians from just claiming the Strait of Hormuz and enacting enforcement through missiles or whatever the case may be, mines? Military options are off the table. I think we both agree that if the Navy could do something, they would have done that already, and we wouldn't be having this conversation. Putting boots on the ground and invading Iran would be the other military solution. I think we just said that nobody wants that. I highly doubt that would even get congressional approval. How would you even claim that? You have to have Congress approve a declaration of war. How do you invade a country without declaring war? I'm not a lawyer. I think that would be difficult. So the options are through diplomacy, either force the Iranians to give up control or to do what the Treasury did. I was just looking at the news 2 days ago, which is to further sanction anybody that is going through the Strait of Hormuz and the Persian Gulf and paying the Iranians a toll. So I'll just read this paragraph from the Treasury Department. Today, the U.S. Department of the Treasury's Office of Foreign Assets Control is further taking action against the Iranian regime's desperate efforts to monetize the Strait of Hormuz and prop up the nation's failing economy. OFAC is designating 2 firms integral to an Islamic Revolutionary Guard Corps-backed extortion scheme that forces commercial vessels to purchase mandatory maritime insurance to transit the strait. It goes on to more detail. I think the Americans will go as far as to start sanctioning other countries, I believe, that will start paying the Iranians a toll to go through. So the Iranians have said that basically they're going to make a toll, okay? I think the rest of the world, from a commercial standpoint, is willing to pay that. I'm going to pay $1 million or $2 million per tanker to go through and not get bombed by a missile. I think that's a relatively low cost for an oil tanker that's cargo capacity is roughly 800 million barrels. Okay, so right there, we can establish that it's not a detrimental cost for oil companies. Trump is not going to accept that for the reasons you've stated. So what are his options? Either force Iran to stop. They're not going to do that. Put a blockade, a secondary blockade outside the Strait of Hormuz. I wasn't really following it. How did that work out?
He's considering. He's now. So 2 days ago, there's a report that the U.S. and Israel are considering a land blockade because the sea blockade is not working well enough. I don't know how they're going to do that. And the reports yesterday, not sure if you saw it, is that Trump has prepared imminent strikes. That's been confirmed by CBS, Wall Street Journal. I'm not sure if you saw that. That's the big news from yesterday. CBS, Wall Street Journal, Axios, and CNN all reported that a massive a campaign is been. Some saying it's already been ordered, others saying it's being considered and very likely. Israeli media today repeating the same thing, that is very likely, more likely. Even mediators are saying war is more likely than peace, than a deal is to be reached. And the reason I started asking you about the strikes on energy infrastructure, what that would mean, is because the reports are saying now they'll be targeting energy infrastructure for the first time. And the Israelis would be participating. So I'm not sure if you saw the reports, but that's why I'm so you say we're coming in with pretty worried today compared to our other discussions, is because of these reports. And then military movements today, embassies putting out alerts all day today, aircraft moving, evacuating from different regions. Iranians are evacuating from different bases and different headquarters, expecting strikes. So all indications are pointing towards strikes being pretty much imminent. And this news came in literally an hour after markets closed yesterday.
The Ras Laffan industrial complex was struck in March, as you recall. That was in Qatar. That was the world's, I believe, first largest or second largest LNG processing facility. Spike in prices, and then prices eventually normalized. The end result will be what the markets have always shown us: spike in prices for whatever commodity or energy product is impacted the most. Eventually, markets find a way to normalize.
Let me ask you this one more time, but in a different way.
Yeah.
If all the energy out of the Gulf is gone, I mean, completely gone. I'm looking at worst case scenario. I don't think this will happen, but I've been optimistic and wrong throughout this entire war. I don't think we'll be here. If it's all just shut down, if this gets completely out of control, we've seen things get out of control historically time and time and time again, where logic no longer makes sense. And I feel like this is something that seeing things not logically kind of breaks you, and I'm in the same camp. Put logic aside. Wars are not logical. If it all shuts down, what happens to the global economy?
You answered your own question. So if hypothetically tomorrow all the energy from the Gulf countries disappear, to answer that question, I'd have to look into a number that I don't have the answer to right now, but I can look it up. We can discuss that if we have him on the show again. How much more can the U.S. export? Because the question isn't, okay, is the OPEC countries, are they the only supplier of oil, of light oil in the world? The answer is no, right? The U.S. is the world's largest exporter and producer of oil, actually, right now. Okay, again, we talked about different refining capabilities, mismatched, and different concentrations of crude. But the point is, the U.S. could, in theory, fill some of that gap. Now, the question that I admittedly don't have the answer to now is how much additional capacity do U.S. producers have right now? I can tell you that it's not a light switch. You can't just turn on capacity. Now, even if we do have slack in capacity, it will take some time to get to maximum throughput. Immediately, what would happen is every single country would have to draw down its reserves. Then the second question, again, I don't have the math right now. The second question is how much of the world's reserves can be depleted before the Americans come online? If the answer is the world has sufficient reserves to wait it out before we have the U.S. and to some extent even Canada increase exporting, then medium term, everyone will be fine. I don't believe that's the case. I think the reserves will run out before that happens. We're talking about a complete change in infrastructure. So no, that's not going to be the solution. So the world's going to run out of energy, in particular, Europe and Asia. Even at the onset of the Iranian conflict, the Philippines already declared a 4-week national emergency. They said they're going to run out of oil in 4 weeks. What ended up happening was they got oil imports from elsewhere. So they were that didn't happen.
China or the U.S.?
Probably China.
Yeah.
So what we have now is a situation where you're describing the end of oil production or export from OPEC or the GCC. And I'm saying, well, the U.S. could fill that eventually, but not right away. And the oil price under that scenario would likely north of 150 for sure. Assuming China runs out of reserves, because China is the wild card here. Every single analyst I talked to before the Iran war, they said, okay, if the Iranians close down the Strait of Hormuz, oil is going to go to 200 immediately. That didn't happen because nobody predicted China would be the wild card. And so we have to bake into this model here, assuming that China eventually will run out of reserves and start to import oil. Then it will need to, under that scenario, 150 at least. We haven't discussed Russia yet, and I have to look into how much oil Russia can supply to the rest of the world. Russia's
refining. Yeah, Russia's refining capacity has been struck. It's been reduced by like 40%. So Russia's crude on that front. They're even importing refined oil.
They don't need to refine. They just need to export raw crude, and the rest of the world.
But there's also issues if you have the Gulf energy infrastructure, the refining capacity. The U.S., from what I understand, I'm not an expert, is maxed out refining capacity. Russia's being destroyed by Ukraine, and if you take out the Gulf, that it's not only the oil that's the issue; it's also the ability to refine it, the refined products as well. But I wanna also you started talking about Asia, and there's something that I saw the note on Scott Besson's desk, and I'm not sure. Of course, I know you can explain this to us because this is your bread and butter. what the hell happened in Japan? Like, it seems to be getting out of control. And I had one of my guests earlier today explain to me how it's so intertwined and why the US could be bailing out Japan, as Japan is such a massive creditor to the US, and the fall of Japan would in a way lead to a fall of the US dollar. That was the kind of the theory he was explaining to me. But can you just explain for the audience what happened in Japan? Is it significant, and why?
I think in a nutshell, the yen, first of all, the yen has been at the lowest level since I think 40 years versus the US dollar. This is a developing story. I'm looking into it right now myself. The US, just to sum up, bailed out the Japanese just overnight yesterday. The US Treasury bought yen on Friday. And how much did they buy? Let me just look it up. They bought a lot. I'll look up the exact number. But the Japanese yen has been falling, and the depreciation has been exacerbated by the fact that fiscal spending has gone up, widened dramatically. The Japanese central bank has tried to raise interest rates to curb that. Didn't work. And why the Americans are bailing out the Japanese is an issue I'm looking into myself. The Japanese yen carry trade is the most important carry trade in the world. And the theory is that if the yen depreciates significantly, if the Japanese interest rate goes up, we could have a massive selling of U.S. assets and U.S. treasuries, and funds will flow into a higher interest rate regime such as the Japanese. I think the concern, if I may offer a theory based on the Japanese yen carry trade, the incentive for the American Treasury, the U.S. Treasury, to put a backstop to Japanese yen bleeding is to prevent a further rise in Japanese interest rates, thereby reversing the yen carry trade, thereby stopping a potential massive fire sale of U.S. assets right before the midterm election. That is the only most likely plausible scenario or theory that I could think of as to why the Americans would step in this massive bailout program, which, by the way, they haven't done in decades. When was the last time they did this? I'll have to look that up as well. Check Scott sent notepad during a cabinet meeting at Camp David in Maryland, showing the words to do, followed by buy Japanese yen, $5 to $10 bill. Look, the Japanese yen carry trade is significant. If the yen continues to weaken, central bank steps in, raises rates, that's going to cause a massive unwinding of U.S. debt and U.S. assets. This comes at the cusp of semiconductors already selling off. And this is right before the midterm. This is all political. So this is not going to look good. If the Japanese yen continues to weaken, interest rates in Japan goes up, and the yen carry unwinds. Peter Schiff, whom you've had on your show and I've had on mine, recently made a video on his channel calling Japan the biggest trigger for a financial crisis in the U.S. right now. So I think it's in the American interest to put a backstop to this, given how much debt the Japanese owns. Not just debt, but also assets. Hence the yen carry trade being the most significant carry trade in the world.
It's almost the biggest creditor to the U.S. The last thing, would love to get your updates on the FOMC meeting. Any takeaways from that, and also anything else I missed that's interesting?
Well, you follow a lot of more interesting things involving, geopolitics and bombs and missiles, and this is just the Federal Reserve talking. So I don't know if anything would strike Mario Novel's fancy. Do subscribe to Mario's channel if you haven't already. He covers a lot more interesting things than Chairman Federal. Kevin
the world is going to end. This is the stuff we talk about. World War III.
This is kind of financial. Reserve. If the Federal Reserve doesn't act soon, the bond market's telling us there's going to be financial World War III. Okay, at least really, let me just set the stage. I'm going to answer your question more directly, but let me just set the stage for what's happening globally. We haven't talked about South Korea yet, but I'm going to make a video this week summarizing the situation. The South Korean Kospi, which up until a few months ago was the number one performing stock index in the world, fell about 33% in July, just in July. This is the worst month in Korean stock market history. It is worse than the 1997 Asian financial crisis. Christ. It is worse than the financial crisis of 2008. It is worse than the top 2000. It is the single worst month in the country's history. Suicide hotlines are ringing off the hooks. It's an unfortunate situation. I think 3% of everybody in the country got margin called. Yeah,
that's crazy, man. That's crazy.
The Kospi index is it's mostly semiconductor stocks that are occupying the top of the chain. Is Samsung, I believe, 29% of the index, depending on the day. SK Hynix is number 2, 23 to 24%. Both stocks hammered. SK Hynix especially. Leverage ETFs. See, most of the retail audience that bought into these stocks didn't just buy the stocks. They bought leverage ETFs, which contributed to the margin calling or expedited the margin calling. So AI stocks are being hammered. No doubt you've seen the story of Leopold Aschenbrenner, $40 billion hedge fund collapsed, bought out by Citadel. So the Federal Reserve is walking into a scenario where a lot of people are speculating is the beginning of the end of the AI trade. At least internationally, that's happening. Perhaps that may be a leading indicator to what's happening in the U.S. Who knows? Now, it's not the Fed's official mandate to control financial prices and stabilize financial conditions, but a lot of economists on my show have said that that's an unofficial third mandate. Certainly, if the financial system collapses or we have a market collapse, the wealthy who do most of the spending will stop spending, hence a recession. So it's not in the Federal Reserve's interest to have a market collapse. They're walking into that scenario. They're walking into the heightened geopolitical situation that we talked about, and they're walking into renewed inflation concerns. The latest inflation print fell, but again, it's one print. Key takeaways from the last meeting on Wednesday: the 10-year yield rose, the 30-year yield rose, and the 2-year yield fell. Why did that happen? The 2-year yield, the short end of the Treasury curve, follows the Fed funds rate. So the Fed funds rate doesn't move, which it didn't. It will either stay flat or fall. The 10-year and the 30-year rose. This is interesting. A reporter asked Kevin Warsh, I keep saying Powell, muscle memory over 3 years. The reporter asked Kevin Warsh, why didn't you raise rates today? And he didn't answer the question directly. He went about it a roundabout way. He said, well, actually, if you look at the bond markets, rates have been rising over the last 40 days. The 10-year has been rising, and the 30-year has been rising. Basically, he's admitting that the bond vigilantes have been doing his work for him. So interest rates rising will put additional pressure on high beta stocks like the tech sector. It's going to make borrowing costs expensive for everybody, corporates and individuals alike. It's going to make eventually mortgage payments more expensive. If you're getting a new mortgage costs will eventually follow the 10-year. And the key takeaway is that the Fed, despite 3 dissents in the last meeting, 3 dissents, Kevin Warsh and the Federal Reserve is still, I think they can go up to 4 dissents, but they are still, despite 3 dissents, unwilling to raise rates, even though the markets really, really, really want them to, which is why the 10-year and the 30-year keeps going up until...
Wants them to, why? Sorry. Yeah. Why does the market want them to?
Because the market believes that inflation is going to get out of control unless the Federal Reserve steps in right now. That's not, that's not necessarily what everyone believes. It's what the markets want the Federal Reserve to do. So right now, the Federal Reserve, according to the bond markets, are behind the curve on raising rates. And the bond market saying, the bond market, the 10-year and the 30-year, they follow 2 things, primarily 2 things. They follow inflation expectations and they follow economic growth. Right now, there's no immediate sign that economic growth is skyrocketing. The U.S. expansion is growing out of control. So it's not following that. It's following inflation expectations. It believes the bond market, which is the world's most sophisticated market, I believe, and is the second largest market after real estate. The bond market is a lot bigger than equities, and some of the smartest people that I know are in the bond market. So the bond market is telling us there is no resolution in sight in Iran. The Strait of Hormuz is not going to reopen anytime soon, which is why it believes inflation expectations or inflation is here to stay, at least for now, and will perhaps go up even more because the energy price is not going to go up even more. That's what the bond market, the world's most sophisticated market, is telling us. It's also telling us that the Federal Reserve needs to raise rates, but because Kevin Warsh is loyal to Trump, and Trump has made it very, very clear he does not want rates to rise before the midterm elections or even after, he's kind of stuck in a precarious position here. The bond markets want him to act, and if Kevin Warsh doesn't act, we're going to get more rising in the 10-year yield, which is going to put additional pressure on equities. and borrowing costs for everybody. I believe the Fed will eventually be forced to raise rates because this can't continue. And I think by September, which is the next meeting, probably if things don't change, we're looking at one hike, probably another one by December if things don't change again.
The last thing I want to ask you is about the 30-year Treasury yield, because a spike in that yield is an indicator of the trust in the government's ability to pay back its debt. And I've been told by a lot of guests of a crisis, crisis limit to what the yield should get to. If it crosses that limit, then the global economy will start to worry. And the number that was shared to me by different guests is about 5%. Is that accurate? Are we getting closer to that? And does that worry you?
Well, the 30-year is already 5%. It's at 5.267. It's at the highest level since 2007, if you count that one spike, but highest since 2004 if you use a historic mean. Okay. It's not just probably the guests on your show and my show saying the same thing. It's HSBC months ago said that 5% on the 10-year, not the 30-year. 5% is the danger zone above which
what's the 10-year at now? What's the 10-year at now? 5 point.
10-year. Let me just pull that up. 10-year is 4.7. Not yet at 5. It was very close to 5. It's at the highest level since 2023. It's getting
the crisis line is at 5% for the 10-year yield, not the 30-year.
Yeah, the 30 years is already above 5. Why 5? I can't give you the math as to why 5. Much smarter people at the banks have already worked out 5% as the threshold. So let's just go with that. Okay, I'm not going to work out the math because someone else already did the work. Let's just go with 5% as a threshold. What happens after 5%? Like I said, it becomes a lot more difficult for banks to pay, for any financial institution and individuals to start paying back debt. Margins are going to decrease if interest costs are high, and people are going to start taking on less debt, which means capital expands less, which means liquidity is less prevalent. To your point about the governments facing existential crisis, yes, we have to first understand that government treasuries have different durations and maturity dates. So if they issue new debt with new interest rates, that's going to be a lot more expensive, but their existing debt doesn't automatically get repriced to 5%, 5.5%. That's still a lower interest cost. So any new debt they issue from here on out will be at a higher interest expense. 5.37 on the 30-year is the highest it's been in 22 years, if you don't count the brief spike in 2007. If it continues upwards, the U.S. Treasury is in big trouble. In theory, what can the government do? Well, they can be Zimbabwe and keep printing money. But as we've seen in the case of Zimbabwe, inflation is the hard constraint here. Economic theory tells us there's nothing stopping the governments from printing money to infinity if they don't care about hyperinflation. But in reality, we that is the hard constraint here, even though that's not baked into in law. What the government is hard capped very soon.
See, told you, economics could be more exciting than Trump's crazy geopolitics. We made it very exciting. We made it more. I don't know if I did. I hope I did. Concerning. We made it more concerning than the Iran war, man.
Let me just finish on one final point. History has shown us that countries are more likely to engage in belligerent behavior when they're at the brink of a financial crisis or already in one. People usually don't start fights out of no reason or their bellies are full. So,
Jesus, did you prep this ending or you thought of it now? That's a hell of a...
You inspired me, Mario.
That was a hell of a way to end the show. That was a good quote. I'm going to actually steal it, tweet it, and take credit for it. Pretend it's mine.
All right, no problem.
David, absolute pleasure, man. Thanks a lot for jumping on. Really enjoyed it as always.
Thank you for having me as always.
Guys, I highly recommend you check out David's channel, the David Lin Report. Great channel, one of my favorite financial channels on YouTube. So I highly recommend you check it. This is it for me today. I hope you enjoyed our coverage, and I will be live. Let me see if Brandon is coming on again. I don't think so. Let me see if the team booked him anything. Nope. So that's it. Me and Brandon will not be live unless, as I said, shit hits the fan. Things escalate. If the US decides to strike Iran tonight, you'll see me live. Otherwise, I'll see you tomorrow. I hope you enjoyed today's coverage. And as always, I'll go through your comments, get your feedback on today's shows. Thank you, everybody. See you tomorrow.